Hello, Mr. Huw Pill. Welcome to this interview in which we are going to talk about an extremely important question related to global economic challenges. So, Mr. Huw Pill, you are Chief Economist and Executive Director for Monetary Analysis and Research of Bank of England, and you are a member of the Monetary Policy Committee. So, Mr. Huw Pill, thank you very much for accepting our invitation. So, as we know, the evolution of the global economic situation in the context of the current crisis is a complex and multidimensional issue. So, the economic health and environment crisis we face today have profound implications for the global economy. So, my first question, Mr. Huw Pill, how do you see the global economic situation evolving in the context of the current crisis?
Well, first of all, thank you very much for inviting me to speak. It's a great pleasure to be here. So what I see is that in the last 15 years, say, we've seen a number of really big disturbances or shocks to the global economy. Probably the first of those was the global financial crisis, which is now back 15 years ago, more or less. But that was probably, if you think of the last crisis of that type, was probably the Great Depression, which was 80 odd years before. And then subsequently, we've had the COVID pandemic. Yeah. And I think if you think about the previous similar event at the global level, it was probably the so-called Spanish flu in 1918, 100 years before. And then, especially in Europe, we've had the war in Ukraine. We've had this big shock to energy prices, given that so much of the natural gas, in particular, from Russia is being supplied to Western Europe. And we've seen a dramatic rise in European energy prices, which probably only has a parallel with the oil price shock of the early 1970s, 50 years before. So we've had in a very short period a whole set of very big shocks to the global economy, very big disturbances to the global economy, which have created lots of ramifications. And they've all occurred one after the other in a very short period. So, you know, speaking at a very kind of high level, a key question, I think, is whether looking forward, and you name a number of other factors, the demographic dynamics, which are changing profoundly, of course, the whole set of issues around climate and what implications that might have. And, you know, speaking today here, you know, we obviously have to recognize geopolitical issues like the recent events in Palestine, Israel, and the Middle East. So, you know, that whole set of issues. So I think a key question is have we entered a new phase where the drivers of volatility in the economy are just stronger than they have been probably for the preceding 20 or 30 years, you know, from the late 1980s, the fall of the Berlin Wall, what a lot of people in macroeconomics called the Great Moderation, where it seemed like the economy was becoming, the global economy was becoming more stable, more smooth, more predictable, more globalized, to a world where, from a combination of maybe physical factors, structural factors, climatic factors, demographic factors, geopolitical factors, the world is just a more uncertain place. And I think, speaking as a policymaker, and a policymaker in a country that's a relatively small country, facing all this global volatility at present, that is an absolutely key issue. Because if you look back over the preceding 30 years, monetary policy in the UK has been quite successful, but it's been successful in a pretty benign environment where the global environment was not presenting lots of problems on a year-to-year basis. That hasn't been the case over the last 4, 5, 6, 7 years. And looking forward, how much you can expect as a small open economy to stabilize your economy, etc., in the face of a much more uncertain global environment is a pretty key question.
Yes, thank you very much, Mr. Huw Pill. So I will move on to my next question. So, what lessons can you learn from? Can we learn from past crises in terms of inflation management and monetary policy?
Yeah. So I think a natural comparison. It was a bit bored of what I just said a moment ago. A natural comparison is how monetary policy has responded to the shocks of, say, the last 2 or 3 years. The COVID shock, the energy price rise following the invasion of Ukraine, and the rise in food prices that also followed that. comparing that period in the early 2020s with the period of the 1970s, where we had the Huw Pill war, we had a rise in gas price, oil prices at that point. We also had rises in food prices and so forth. And I think one really key important lesson we should take away is that, and this is particularly oriented towards monetary policy, which is my business, so that's why I focus on it, but I think it then magnifies to other policy areas, is it's very important that policymakers are given clear objectives, are given the tools to achieve those objectives, and are given the independence in order to use those tools in the appropriate way. So if you go back to the 1970s, monetary policy in the UK at least, and in many other countries, was still run by the government. It wasn't run by an independent central bank. And it wasn't entirely clear what the objective of monetary policy was. That wasn't spelt out. And as a result, the private sector, the financial markets, the rest of the economy, didn't really know what monetary policy was going to do. And in particular, they didn't know that they were going to act to keep inflation low and stable, or to the extent that inflation had risen on the back of higher energy prices, that they were going to act to return inflation to low and stable levels. And because of that, inflation expectations became unanchored. They began to drift around. And if one thing we know is that, you know, when you're setting prices on the basis of what everybody else is setting prices on. If you set your prices too high, all your customers will go elsewhere. Yes. So what's key is that you have to form an expectation of what inflation is going to be in order to calibrate where you want to set your prices. When that expectation of what inflation is going to be in the future gets unanchored, because people don't know whether policymakers, particularly monetary policymakers, are going to act to get it back down, then the economy can become very destabilized. Inflation go everywhere. So in Europe, we had inflation rates running at 20+%, and the economy and the whole stability and macroeconomic environment in the economy became very unstable. What's been key, I think, in the face of the big shocks, and they're comparably big shocks over the last few years, is that we've moved in an environment, what we call in the UK, inflation targeting environment. So the Bank of England has been made independent. It's been given responsibility for monetary policy, and it's been told monetary policy should be used to return inflation to the 2% target. Yeah. So what we've seen is, yes, inflation has gone up. It's basically been proved very difficult to manage inflation 1 month ahead, 2 months ahead, 1 year ahead even, in the face of this volatility, these big shocks that I've described. But we are committed. I, as a member of the Bank of England's Monetary Policy Committee, as you said, I'm committed to acting to get inflation back to 2%. We've had to tighten monetary policy. We've put interest rates up. We are working to get inflation back to 2%. We still have a little way to go, but we're making progress, I think, and I'm confident we will achieve that. But what's been crucial is that price setters, wage setters, cost setters in the UK economy, to a large extent, they have believed we're going to do that. So we haven't seen this unanchoring of inflation expectations. And because they're behaving on the basis that 2-3 years down the road, inflation will be back to 2%, they're setting prices compatible with that, and that's helping to keep inflation, bring inflation down and keep inflation more low and stable. So I think the kind of key message I would take away, and I've given the specific example that applies to my job, yes, but the key message to take away is you need policymakers to have clear objectives, give them the tools they need to achieve those objectives, and give them the independence that they need in order to employ those tools in the right way. That implies that, you know, they need to be held to account, so they need to be transparent about what they're doing. They need to communicate more than perhaps they did in the past. This podcast is an example of me trying to communicate. Yes. But I think it's that combination of independence, accountability, transparency, clear goal of what you're trying to achieve, and the right assignment of the tools of policy to the right goals.
Okay, so thank you very much, Mr. Huw Pill, for this clarification. So I will move on to my last question. So as a member of the Monetary Policy Committee, how do you see the impact of the current monetary policy on long-term global economic stability?
Well, what I would like to see is that, you know, our monetary policy in the UK is, as I said, oriented to achieving this 2% target. I mean, in the big picture, from a global perspective, the UK is a small economy. Yes. But I think we are part of a community of central banks. And we look to our peers, our bigger peers, the European Central Bank, the Bank of Japan, and of course, above all, the Federal Reserve in the US. And all of us have a similar target, to get inflation to 2%. And by acting to make sure that 2% in our countries is inflation is 2% in each of our countries, we're helping to stabilize prices across the whole global economy. And I think that that's a very important contribution that monetary policy and central banks are making, because it's providing this anchor, it's providing this medium-term stability to the economy, so the global economy doesn't become unanchored and sort of more volatile. But it's doing so in a way that then creates an environment for other policymakers and the private sector and other actors to behave in a way that improves growth, improves living standards, improves our resilience to climate change and so forth and so on. So I think the key thing is monetary policy has to do its job. Its job is to maintain price stability. Price stability is not a solution to all the world's problems. Yes. There are many other challenges the world faces, but it's better that monetary policy and central banks focus on what they can do and create the environment for other actors to do their job. And we have a lot to do as society, as a global community. Yes. But if monetary policy gets distracted and say monetary policymakers begin to become, we have to solve the climate problem, we have to solve the distributional problems between North and South or within different countries, then I think the danger is that we lose that anchor of price stability and the overall environment becomes more difficult. So I think there's a need for kind of humility. We cannot do everything, but there's a need for focus. Let's do what we can do and do it well.
Yes. So thank you very much, Mr. Huw Pill, for your time and for your answers. And it was a pleasure to discuss with you. Thank you very much.
Well, thank you for the invitation.
Thank you very much.